Friday morning, April 3rd, Good Friday, Passover, nobody home on Wall Street. And at 8:30 in the morning New York time, a borderline April Fool. The much watched, most important single report every month is payrolls, jobs, the employment change from the immediately prior month. And the job count came in half the forecast. January and February revised down. No particular change in incomes, although a little bit of an uptick. And the instant response of the bond market is rates down, mortgage rates down. We're 3.375, maybe going lower. As a technical matter, meaning the propeller heads who keep track of chart patterns as a guide to trading, which everybody at every trading desk does, is a setup to go back down to the lows of the year so far this year and test them and maybe take them out. The job report and the associated economic data on first blush are weak enough that there's no basis for the Fed to raise rates maybe any time this year, certainly not early summer. That's on first blush. In the copy beside this video, I'm a little more nervous than that. The economy is better than this number says. There's an important wrinkle in jobs having to do with the Fed, that the Fed doesn't care about exactly how many new jobs are created every month. It cares about the unemployment rate as a proxy for upward pressure on wages, and we're already in the historical danger zone. The uptick in wages last month is minor. It's 2.8% annualized, but that's up from 2.1 year over year. And Janet Yellen was very clear last week in a speech about conditions in which she would not want to raise the Fed funds rate. These are not those conditions. They're not as weak as she said she would want to see in order to suspend liftoff. So if you've got a mortgage to do it now. Take what the market's got. Don't be mad at anybody if rates do in fact go lower. But we will need to see a succession of reports like this. At least one more like this, maybe two, for it to be clear that the Fed really will suspend its effort to lift off from zero. Fed's got two agendas here. One of them is just to get off zero because it's unnatural and it tends to create bubbles in financial markets. The second, longer running one is to intercept potential overheating in the job market. And that second mission took a step back on today's report, but nothing happened to the first one. The Fed desperately wants to get off zero to some degree. And after a report like today and the reaction to it that's overdone, it just makes the market more vulnerable to the first quarter point from the Fed when it comes. Thorough mixed message, but it's spring. Happy Easter, happy Passover.